Picture this. You own a rental property, you've been dutifully lodging your tax return every year, and you assume you're claiming everything you're allowed to. But if you've never ordered a depreciation schedule, there's a very good chance you're quietly overpaying tax, and it's not your fault because most investors are never told this exists. CanStar's modeling shows that skipping a schedule on a typical new build unit can mean walking away from around $100,000 in perfectly legal deductions over just the first 10 years. Today, I'll walk you through exactly how to fix it, step by step. And the good news is, it's more straightforward than you think. Here's why this matters so much for you. According to CanStar, roughly 98% of a new residential build's construction cost is depreciable for tax purposes. That means if you own a $400,000 build, it can support around $392,000 in total deductions over its life. And I want to be clear, this isn't a loophole or anything gray. This is the ATO explicitly allowing you to claim the decline in value of your building and its fixtures. It's a genuine quirk of the Australian system that works in your favor, if you know to use it. Before you touch any tools, let's get clear on what's actually at stake for you. The ATO lets you claim two things each year. First, capital works, that's the building itself. And second, depreciating assets, the fixtures and fittings, like carpets, appliances, and air conditioning. CanStar found a brand new property can generate around $16,000 in deductions in year one, and close to $100,000 over the first decade. Every year you go without a schedule, that deduction is simply gone. You can't get those past years back once too much time passes. But here's the part most people miss, and it's coming up next. The exact dollar cost of doing nothing. Let me make this concrete in actual dollars because that's when it hits home. If you own a typical property built between 2000 and 2020, not having a schedule means losing roughly $65,000 in deductions over 10 years, according to CanStar. At a 37% marginal tax rate, that works out to around $24,000 of extra tax you've handed straight to the ATO over the decade. Think about what $24,000 could have done for you. Extra loan repayments or the start of another deposit. That's real money leaving your pocket for no reason at all. So here's your first concrete move. You engage a quantity surveyor to prepare an ATO-compliant tax depreciation schedule. That's a specialist who's legally qualified to value your building. Use a recognized firm such as BMT, Washington Brown, or Duo-Tax, all named here as illustrative examples rather than recommendations, and always check they suit your situation. Ask for a quote first, then give them the property address, settlement date, construction date, purchase price, and any renovation history. Now here's the part that surprises people. The surveyor's fee itself is generally tax deductible, so this is rarely money out of pocket in the long run. Once you've engaged them, the surveyor inspects the property, and here's a relief for you. They can liaise directly with your property manager or tenant, so you don't have to coordinate access yourself. They identify every eligible capital works item and depreciating asset, which is exactly the part most DIY estimates miss completely. According to BMT's service description, you can often receive the finished schedule within about 7 days of supplying everything they need, and that single report covers up to 40 years of deductions, so you order it once and it works for you for decades. Here's what a good result looks like, so you can sanity check your own report when it lands. If you've got a brand new property, CanStar's modeling suggests first-year deductions in the 5-figure range, around $16,000. If you're on the more modest end with a property built between 2000 and 2020, expect total annual deductions of roughly $6,500 in the early years. And if you're somewhere in the middle, you'll land between those two. If your schedule comes back well below the benchmark for your property type, that's your cue to ring the surveyor and ask why. Your second move, don't just accept the default that lands on your desk. Sit down with your accountant and confirm which depreciation method you're using. Prime cost gives you a uniform deduction each year, while diminishing value front-loads bigger deductions early on. Under ATO rules, assets costing $300 or less can usually be claimed immediately, and assets under $1,000 can go into a low-value pool for faster claims. Now, I want to be honest with you here. Diminishing value isn't automatically the right choice for everyone. If you're planning to hold long-term and prefer steady, predictable deductions, prime cost might actually suit you better. It genuinely depends on your cash flow goals, so this is a real conversation to have. While you've got your accountant's attention, review the schedule against the ATO's published effective life tables and depreciation formulas. This might sound like busy work, but here's why it matters to you. The ATO requires you to keep records showing how you worked out the decline in value, so this step is what protects you if you're ever audited. Effective life determinations get updated periodically, so make sure your schedule uses the current rulings, especially before any major renovation or asset replacement. And here's where it gets genuinely interesting for anyone who's owned their property a while, because you might be owed money right now. Third move, and this is where people get real refunds back into their pockets. If you've owned the property for years without a schedule, you can backdate the missed depreciation. You don't just lose it forever. Take your completed schedule to your accountant, identify every year where you underclaimed, and lodge amended returns through ATO online via MyGov or through your tax agent. CanStar's guidance confirms the exact process: quantity surveyor first, then your accountant to amend the prior returns. There are limits on how far back you can amend, so the sooner you act, the more you can recover. The payoff from backdating can be significant for you. If you've got a typical property built between 2000 and 2020, CanStar estimates properly backdated claims over 10 years can approach $65,000 in extra deductions, assuming you previously claimed very little. If you own a brand new property instead, that figure climbs toward $100,000 over the first decade. Here's my tip. When those refunds come through, don't let them dissolve into everyday spending. Redirect them into extra loan repayments or your super, and you turn a tax admin task into genuine wealth building. Your final ongoing move is simple maintenance. The good news is a tax depreciation schedule doesn't expire. It can cover up to 40 years of deductions. But it does need updating whenever you add new assets, renovate or replace fittings like a hot water system or an air conditioner. So each time you make a major change to the property, ask your surveyor to refresh the schedule against the current effective life rulings. That way you keep claiming every single dollar you're entitled to, year after year, and you never accidentally leave new deductions on the table. Now let me bust the myth that costs people the most. So many investors skip a schedule because they believe depreciation only matters for brand new properties. That's simply not true. CanStar's modeling shows properties built between 1987 and 2000 can still yield around $4,000 per year. That's roughly $40,000 over the first 10 years. The ATO allows capital works and asset deductions on residential rentals regardless of age, so please don't write off your schedule just because your building is older. If that's you, you're likely leaving money behind for no reason. The second common trap is relying on a rough DIY estimate from your accountant, and this one catches out even careful investors. Here's the thing: accountants aren't qualified to value the capital works on your building. Only a quantity surveyor can legally do that. So if your return only shows a few $1,000s of obvious appliance depreciation, you're almost certainly missing the much larger capital works deduction. That gap can easily be several $1,000s a year, which is precisely why a professional schedule pays for itself many times over. It's not an expense, it's the thing that unlocks the bigger claim. Let me run the whole plan back for you quickly, so it's clear in your head. 1. Order a professional schedule from a quantity surveyor. 2. Confirm with your accountant whether prime cost or diminishing value suits your cash flow. 3. Verify the effective lives against the ATO tables. 4. Backdate any missed years through amended returns. And 5. Update the schedule whenever you renovate. Do those 5 things and you stop paying tax on rental income you never needed to be taxed on in the first place. It's a handful of steps for potentially tens of thousands back. If you've made it this far, you now know something most property investors around you simply don't: that there could be tens of thousands sitting unclaimed in your rental. Your one action today is easy. Ring a quantity surveyor and ask for a quote. It takes about 10 minutes. If you want to go deeper, next up I'm walking through negative gearing and how depreciation supercharges it at tax time. Just remember, this has been general information only and not tax advice, so check your own numbers with a registered tax agent before you lodge. I'm Sophie. I'll see you there.